Okay, let's talk about a huge financial story that's unfolding right now. It affects hundreds of millions of people, and it all boils down to one currency, the Indian Rupee. It's been on a slide, and in this explainer, we're going to break down exactly why that's happening.
The number everyone is watching is 90. 90 rupees to the US dollar. And look, this isn't just some figure on a trading screen. It's a massive psychological barrier for India's economy, and frankly, it's making a lot of people pretty nervous.
So, you've got to ask, right? What's really behind this fall? Is it just one thing, or are we looking at a whole bunch of factors all hitting at once? Let's dive in and really get into the mechanics of it. We're talking about a currency that's really on the edge here, and believe me, its value is so much more than just a number on a chart. This trend has an impact on everything, from huge global trade deals right down to the budget of an average Indian family. What we're really looking at is a perfect storm of pressures coming from both outside and inside the country. We've actually pinpointed 6 key forces that are driving this slide, so let's tackle them one by one.
All right, force number 1, the mighty US dollar. You have to understand, right now, the dollar is the strongest it's been in years. Think of it like a giant global seesaw. When investors around the world get nervous, they all rush to the safety of the dollar. So as the dollar goes up, other currencies, especially from emerging markets like India, almost automatically go down.
Next up, force number 2. And this one's about what the U.S. central bank, the Fed, is doing, or rather not doing. See, everyone expected the Fed to start cutting interest rates, but they've been delaying those cuts. That makes holding on to U.S. assets more attractive, which causes investors to pull their money out of markets like India and send it back to the U.S. That's a classic case of capital outflow. And that leads us right into our third force, foreign capital flight. It's not just about the Fed's decisions. We're seeing huge withdrawals from Indian stock markets, and the outlook for foreign direct investment, FDI, has also gotten weaker. All of this just piles immense downward pressure on the rupee. And then you've got force number 4, trade deal nerves. Specifically, there's a real lack of clarity around a major trade agreement between India and the US, and that uncertainty makes investors jittery. When investors are nervous about trade stability, they're just less likely to bring their money in, which again hits those crucial foreign cash flows. Force number 5 is a huge one, a record-high trade deficit. To put it simply, India is buying a lot more stuff from the world than it's selling to the world. And when you import all those goods, you usually have to pay for them in, you guessed it, US dollars. So, that massive demand for dollars to pay the import bills just keeps weakening the rupee.
And our 6th and final force, wow, this one's fascinating. It's a bit of a head-scratcher, really, and it's all about global trade dynamics. So when the U.S. puts tariffs on certain Chinese goods, it creates this surplus of stuff that China can't sell to America. So where do those goods go? Well, they often get rerouted to other markets, like India, and sold at a lower price. This flood of cheaper Chinese goods actually boosts India's imports, which in turn increases the demand for U.S. dollars to pay for them. It's a really complex global ripple effect.
Okay, so let's just pull all that together for a second. You've got the global headwinds on one side, that super strong dollar, the US Fed's policy, and those weird tariff effects. And then on the other side, you've got domestic pressures, a weak outlook for FDI, that record trade deficit, and the uncertainty around trade deals. You can see how India is basically fighting a battle on 2 fronts here. So we've covered the why of it all. Now let's get to the really important part, the so what. Why does a weak rupee actually matter? This is where we connect all these big, abstract economic forces to the real-world impact on businesses and, well, on you. This situation is a classic double-edged sword. On the one hand, yeah, it's tough. Imports get more expensive, which can lead to inflation and weaken investor confidence. But there's another side. A weaker rupee makes Indian exports cheaper for the rest of the world, which can make them more competitive on the global stage. It's a really delicate balancing act. Okay, so let's bring this down to earth. What does this actually mean for your wallet? We're talking about crucial imports like crude oil, so that means you're going to pay more at the pump. The price of electronics, from your smartphone to a new laptop, that goes up too. Even the heavy machinery that powers India's industries costs more to bring in, and that can have a knock-on effect on prices pretty much everywhere.
And that quote really hits the nail on the head when it comes to confidence. A currency that's just constantly falling sends a signal of instability. And that's exactly what discourages the kind of long-term investment capital that's so vital for a country's economic growth.
All right, so with all that pressure, what's the game plan? What can actually be done about it?
Well, the path to stability isn't about some single magic fix. It's going to require a multi-layered strategy to get the rupee back on solid ground.
So experts are pointing to a kind of 5-point playbook for recovery. Let's walk through it. First, strengthen that foreign direct investment by creating stable, predictable policies. Second, you've got to boost exports to bring more dollars into the country. Third, focus on reducing how much you depend on imports. Think about making more crucial things like electronics right there at home. Fourth, get those pending trade deals signed and sealed to provide certainty. And finally, number 5 is to very carefully manage the currency's day-to-day volatility.
Now, that last point, managing volatility, is really important to understand. It doesn't mean the Reserve Bank of India should just jump in and fight the market to defend some artificial price. No, instead, it's about intervening just enough to prevent those really sharp, sudden, and damaging swings. It's more about smoothing out the ride than trying to steer the car.
And all of this boils down to one massive dilemma for India's policymakers. Do you defend the rupee at all costs, burning through those precious foreign reserves? Or do you step back, let it find its natural market level, and just deal with the consequences? That, right there, is the billion-dollar, or maybe I should say the trillion rupee question.